Stephanie Link is chief investment strategist at Hightower and a CNBC contributor. And Stephanie, let's just start with the Nike news. I guess the big piece of this is that the China business is still pretty strong.
Yeah, actually, that is definitely a highlight, up 12% on a constant currency basis. That's the second quarter in a row, Becky, of double-digit growth in China. And you know, I have been bullish on the consumer China and kind of the reopening. And so it is certainly playing out. They are taking share in China. That's number one. Number two, the Nike brands were up 2.5%, but they saw ASPs rise in every geography as well. That's helping margins. Jordan brand grew double digits. And I think the most important number is the EBIT margins. They beat expectations by 180 basis points. Why is that important? Because the company has a goal of getting that to the upper teens in the next few years. It came in at 12.5% this past quarter. So if they can get to the upper teens, that means this company has a chance at getting to $6.50 in earnings power, making the stock pretty attractive for the next couple of years.
I was going to say you liked the stock before it was up 10%. You still like it here, though, just because of what you see as the long-term strategies?
Yeah, I think the worst is behind them. I think the higher spend is behind them. I think they're focused on profitability, much more focused on profitability, which is a good thing. And yeah, you know, the stock is still down. If you know those up 10%, it's still down 10% on the year. It trades at 24 times earnings. It's not cheap, Becky. But the last 10 years, it's traded at 28 times on average. So they've seen a very big de-rating, and I think you're going to see a re-rating as they can deliver.
You know, we've also looked at Foot Locker and Nike and Dick's Sporting Goods shares were higher, too. But is Nike benefiting at the expense of some of those other companies? Like, if they are getting higher margins, in part, it's because they're going direct to consumer.
Yeah, I think that they are taking market share, direct to consumer, China, as I mentioned, Jordan up double digits across every segment. So they are absolutely the number one player. Anytime you can get the number one company on sale at a discount to its historical multiple, you got to take that chance, right? I mean, because especially given the visibility. And oh, by the way, they have a very strong balance sheet and a $17 billion buyback. They bought back $1.1 billion in this past quarter. So they certainly got a good price.
Do you like any of those other companies, though, that we mentioned?
No, not really. I think they're a lot more volatile, right? And so I'd rather just play, you know, if you want to play these other names because of the Nike exposure, well, I just rather own Nike, quite honestly. I also think that, you know, there's really a change in the industry. Like, there are the winners, Becky, and then there are the losers. And the winners we know from Costco and Walmart, TJX, you and I have talked about, Nike being one of them as well. All of these are best in class. And I'd rather buy any of those on sale at a discount multiple, especially if you have a little bit better visibility and kind of profitability improvement.